Pat Moran with Healthier Money. I'm really excited to have Dan McGrath with me tonight from IRMAA. And when I say IRMAA, he's probably the #1 authority in the country on this subject, and with a number of retirement planning ideas and tax reduction strategies. In particular, we're going to focus tonight on IRMAA. I don't think a lot of people know what IRMAA is, if at all. So why don't you just take a second to explain it a little bit?
Thanks for bringing me to Arizona.
Sure.
Not many people understand the subject. IRMAA is very simply a tax or a surcharge on your income in retirement. IRMAA stands for the Income-Related Monthly Adjustment Amount set up by Medicare. So when you retire and go into Medicare, they're going to look at your income, and the more income that you have in retirement, the higher your Medicare costs are going to be. They're ultimately going to tax you again on the very same dollar.
So is this a real problem?
So currently, right now, should you be worried about it? If you're 50, 55 years old and you've put in more than $25,000 into a traditional 401k, the way the current regulations sit, and if we still get the same stock market performance, you're going to reach IRMAA. And what that means is you're going to lose the majority of your Social Security benefit.
How?
So the wonderful part of federal regulation and law, your Medicare premiums automatically, the bulk of them are automatically deducted out of your Social Security benefit.
Okay.
So when you reach Medicare's IRMAA, your Medicare premiums are going to go up by, have it be 40 to 300% more,
Wow.
and they're going to come directly out of your Social Security check, which isn't inflating at the same rate.
So I know you're really passionate about this, and when I started learning more and hearing about it, I definitely saw the the importance of this too. Why are you on your soapbox and yelling and screaming about IRMAA? Start planning for it, getting around it.
The biggest thing is the fact that there is no financial firm currently educating people about the subject of IRMAA.
Okay.
The federal government is doing what it can to disseminate information. You can find information at socialsecurity.gov, the Code of Federal Regulations, Medicare.gov. The financial industry isn't doing its due diligence or isn't prudently telling people what retirement is. My passion stems from the fact that when I was inside the financial industry, I didn't help even my own mother, and by not informing her about how Medicare works and the rules and regs, I actually hurt my own mother. So if I can hurt my own mother, who I care as much, with the exception of my kids, she's the most important person in my life, then I need to save everyone else. And that's the reason why I'm doing this.
Is IRMAA really important?
So it depends. Now, there are going to be plenty of people saying that they don't necessarily need the money. Well, when you lose more than 100% of your Social Security check, is that enough? At what point, what is the number that you are willing to give up and sacrifice before saying it's too much? Is it $1 or is it your entire Social Security check?
If I play out your argument then, and I lose all of my Social Security, what happens to my Medicare?
It continues to increase.
So if my Medicare comes out of my Social Security and all my Social Security has been eaten up,
You have to write a check to the federal government on a quarterly basis.
That's a problem.
Well, here's the good news. The problem's solved because the federal government will send you a self-addressed envelope back to them that you get to put your check in.
And literally, you could end up paying thousands and thousands of dollars.
Well, literally, it's happening right now. People, their Social Security benefit isn't paying their Medicare premiums, and they're writing checks to the federal government now. And the fun part is they're still paying the tax on their Social Security benefit.
So then why is everybody still saving in tax-deferred qualified plans, and that's still the gospel?
So currently today, people believe that they're paying too much in taxation.
Okay.
Granted, it is the lowest income tax bracket we've had in modern history, but people believe that they're currently paying too much in taxes. They all realize that taxes are going up in 2 years. Okay. So what they're trying to do is make sure that they don't pay tax now in the lowest tax bracket environment. While they're working and generating money, what they want to do is they want to pay taxes later on when they can't afford it, they're no longer working, and the tax brackets are actually going to be higher. Now, they'll be in a lower tax bracket, so let's say somebody's in the 24% tax bracket today, which will be going up to, I believe, 27 or 28. When it's 27, 28, when they retire, they'll be in the 22% tax bracket.
Okay.
That's what they're hoping for.
Right.
But that they have to realize that once they go into retirement, that tax-deferred dollar will be taxed 4 different times.
Okay, explain.
So, people that are putting money into tax deferral today
Okay.
are going, this is what CPAs, accountants, employers, financial professionals, best friends, college roommates that read a book about finance
Right.
when they were in school.
Defer.
Defer. And the reason is you're going to get a tax break today in the lowest tax income bracket in the history of, or the modern era. And eventually, later on, you're going to have to pay taxes, but you're going to beat the government. And they are. They're effectively going to beat the government. So you get one tax today, and then tomorrow, when you take the money out at age 72, you're going to be in a lower tax bracket. You've effectively beat the government, one-on-one. You win. But what the government also does, and what no one tells anybody, is they use this RMD to tax your Social Security benefit. So you take the RMD that counts as income, they add that to half of your Social Security benefit, and if your Social Security benefit's over $34,000, the combined half of Social Security benefit and the RMD, 85% of your Social Security benefit's taxed.
So in essence, I deferred $1. I'm following your argument here. It's funny because if I asked 100 people in a room where they thought taxes were going over the long term, they'd all say
Everyone says
up.
up, going up.
Yeah, so then what you're saying makes it's hilarious. Then if you know taxes are going up, why are you deferring today to only pay taxes in a higher bracket later on? But then you're also saying there's other taxes that are going to come into play.
Yep.
So this dollar that you're saving now could end up actually costing you a lot more because future taxes on your Social Security, on
now
IRMAA, income tax.
So to piggyback on, now that your Social Security benefit's taxable,
Okay.
how IRMAA works and how Medicare works is Medicare looks at the amount of income you generate. So they look at not only that RMD, but now they also look at your taxable amount of Social Security. Not half of your Social Security benefit, the taxable amount. So you've maximized your Social Security benefit because you got poor advice, because the last thing you want to do, or the third to the worst thing you can do, is maximize your Social Security benefit. You've maxed, because if you have that tax deferred asset, you have that RMD that's going to get added to half of your Social Security benefit, which is going to get you to an 85% taxable Social Security benefit. So now that taxable Social Security benefit gets added back to the RMD. You reach Medicare's IRMAA, what happens to your Medicare premiums? They go up. Yep. And now how do you pay for your Medicare premiums? Through your Social Security check. So you're taxed 4 different ways because someone told you you're going to beat the federal government once. Did you really beat the federal government?
For the first time yesterday, in all these years I've been in the business, I had a business owner tell me, we shut down our 401k 2 years ago because I felt in principle I was having my employees save money now on their taxes only to pay more taxes down the road because I felt taxes were going up.
And that person...
And I felt I wasn't doing them a favor.
So not only is that person 1,000% correct, because the tax breaks that were passed in 2017 through the former President of the United States, those sunset in 2025. So the tax brackets that you're paying today are going to reset to the tax brackets in 2017. And then once they reset to 2017, it's already been alluded to that Congress may change the bands inside those brackets, so people will end up having to go back to a higher bracket, but then even being in a higher one because the income brackets are going to change. So that employer, what that person did is not only accurately predict the future, she did the right thing by her clients, or right thing by her employees. The harsh punishment that the employers don't get is they're effectively hurting their employees with the retirement plan.
So essentially, if you're an employee, you'd want to seek out, if you had a Roth option in your 401k.
So a Roth option's good, but then they're going to say, what about the company match? So for an employer to get the benefit of the company match, they have to put that company match, that 3 or 6%,
Some companies won't
in a
do that.
traditional 401k, and that's going to end up hurting the employee. If a company was actually smart and they effectively actually cared about their employees and they cared about retaining the employees, you use this product called life insurance. And what you do is you open up a life insurance policy, which they used to do back in the 40s, 50s, 60s, 70s, and 80s. And it's what the NFL does, is you open up a life insurance policy on the person. You have an insurable interest on them.
Sure.
And then after a certain number of years that they've stayed with you and rewarded you, or you reward them by, you have the insurance policy. And that insurance policy, or the cash value with inside of it, doesn't count towards Medicare's IRMAA, doesn't count towards taxation, and the employer can possibly write that off as well.
Well, this speaks to a bigger issue, and IRMAA is just one subset of many different things that we don't control,
Yes.
that the government can change at any time, and yet it sounds like we've got this great tax planning tool that circumvents all of this with life insurance.
Yes.
And last time I checked, life insurance has been around for 160 years.
Well, life insurance has been around, if you go back to the Roman days, there's always been life insurance. It's just a question of how our society is adapted, and yes. So I like to tell people the fun part of looking at life insurance and looking at your tax code. Your tax code was created in 1913.
Okay.
It had 196 characters. Today, your tax code is over 36 million characters, and what's the only financial instrument that hasn't changed? A whole life insurance policy is identical today as it is in 1913, as it was in 1910. It's never changed.
It's unfortunate because I think life insurance is shrouded in so much misinformation, so many misconceptions, that people are really missing the boat on something that could be a powerful piece in their portfolio.
Well, it's not, not to beat up on life insurance, it's not sexy. So if you want sexy, I can turn on CNBC, I can turn on Fox Business, I can look at the scroll, I can see the stock that I own, or the mutual fund, I can see if it goes up and down each day, and it turns into a game.
Nice story to tell at a cocktail party.
Great, I picked XYZ stock or XYZ company, it's gone up, look at me, I'm great, I'm professionally gambling. That's what it is. Life insurance is not exciting, it's downright boring, and it's not about telling people what you have, it's being all set for the rest of your life. Life insurance, and even the life insurance companies will not tell you this. Life insurance manages all of your health care and retirement, and it saves your Social Security check. And when we say effectively controls or manages all of your health care costs, if you have assets and revenue coming out of life insurance, it doesn't count towards Medicare's IRMAA. So your Medicare premiums stay low. Now your Medicare premiums stay low, they still come out of your Social Security check. We can't solve that. But your Social Security check, you'll still be able to capture, you'll still be able to get some, you won't lose it all. The other beautiful part of life insurance, the other issue people should be concerned about is long-term care.
The living benefits.
So the reason why you want the living benefit from life insurance, people believe that they're going to actually convalesce in a nursing home. So one of the questions that I like to ask when speaking to people and doing a seminar, I ask one simple question. How many people believe they're going to be in a nursing home? And then when no one raises their hands, I say, congratulations, you are all 100% correct. There is no chance on God's green earth that states you're going into a long-term care facility. It's never going to happen. And the reason why it's never going to happen is because of demographics and math. It's very simple. What we know from the US Census and what we know from the Kaiser Family Foundation is that there are currently 15,618 long-term care beds. I'm sorry, no. There are 15,168 long-term care facilities in the United States.
Okay.
Of those 15,618 long-term care facilities in the United States, there's 1.6 million beds. Last time I checked was in 2017, 2018. We had a 92% occupancy rate. So there are less than 300,000 beds in the United States available for long-term care.
We haven't even seen the major part of the population.
Now,
coming
there's
through.
1.6 million vets. Now, ladies and gentlemen, how many baby boomers are there?
A lot.
So let's say there's 72 million baby boomers.
Okay.
What we know from the American Medical Association is roughly 25%, I'm sorry, 70% of baby boomers are going to need some form of long-term care. Doesn't mean they need to stay, they're just going to need some form of long-term care. That's about 54 million people. Of the 54 million people that are going to need some form of long-term care, 25% of them are going to need to stay in a long-term care facility. So that's between 10 and 11, maybe 12 million people. So now here's the question. Where are 12 million people going to fit into 1.6 million beds?
They're not.
So where are they going to convalesce?
At home.
So how I know you're not going into a long-term care facility is you better have a real lot of money or you better have a real lot of life insurance to pay for it. So you're going to convalesce at home. Now, the reason why you need the living benefit and not long-term care, or the reason why you need cash value, your home, which I'm going to shoot out there, are the hallways wide enough to accommodate 2 wheelchairs?
No.
Are they wide enough to accommodate 2 walkers?
No.
Okay. Now, in Arizona, in this area, I do know that a lot of homes are single, 1 floor, which is great. But if we take a look at the Northeast, we take a look at the coastal cities in California, how many houses have the master bedroom, the master bath, the laundry, the kitchen, all on 1 floor? None.
Well, if they do, they're mostly upstairs.
So they have stairs. A chair lift for just 4 chairs is about $1,500. That's on eBay used. You want to widen the hallways to accommodate a wheelchair. You want to adult-proof the bathroom. Here's a quick question. Take a look at somebody who's 6 foot. Are they reaching the cabinets now when they're healthy? What's going to happen when they're 85 years old? Can they reach those cabinets? So everything has to be adult-proofed. How are you going to do it?
Right.
Now, your financial advisor that's going to say, take money out of that tax-deferred vehicle, and once you take money out of that tax-deferred vehicle, that's a distribution from the traditional 401k, your Medicare premiums are going to skyrocket, your Social Security check's going to go down. But if you have life insurance or Roth, or that's it, life insurance and a Roth, you take money out that way, it doesn't count. And by the way, where's everyone going to convalesce? At home. One of the reasons why we're also big proponents of looking at a reverse mortgage. You're sitting on an asset that you're not going to use, that you need to stay in and you need to be able to afford because of the property taxes.
Well, the thing that's sad about that is for some reason, you mention the word reverse mortgage and people, for the most part, freak out. They think it's so bad.
Because the mindset,
The misinformation.
it's not misinformation, it's habit. So everything that we do in our society is habit-based. And no one wants to change habit. Because once you change habit, you change pattern. Once you change pattern, there is no projection. There is no looking to the future to see what's going on. You have nothing but chaos. So habitually what people do is they own a home. When they pass, the home goes on to the kids.
Right.
Now, for millions of years, the kids, or tens of thousands of years, the children would live in the home. It's not the case in our more modern society. But we're still hardwired to make sure that people have a place to live for protection, whatever it may be, that need for our family. Today, looking at somebody saying, well, instead of giving up your home, put it in a trust, well, what happens when you finally do need long-term care and you can't afford it? Well, go on to Medicaid and get a long-term care facility. Well, that long-term care facility can put you 50 miles away from your residency. Now you're going to spend the rest of your days away from society, away from your family, your loved ones, out of your home that you built with the love of your life. Sorry, no, just do a simple reverse mortgage. We're against it because it doesn't get passed on, if not set up correctly, to the next generation.
Well, yeah, and people, unfortunately, I'll usually say, well, what have you heard? And they can't tell me. or what they heard was 10 years ago when it was the Wild West in reverse mortgages.
Even if it was 10 years, even when it was the Wild West.
Cleaned up.
This is going to sound kind of harsh, but I can assure you, for 99% of the people that will see this video, their children don't want to show up every third Sunday to mow your lawn. They already have a home. They're already stable. That was your job. That was your role. Your job now is to ensure that you spend the rest of your days comfortable in a style that you can afford in the home that you built. How do we do that? Because here's the problem. Your traditional 401k savings has been marked by the government through Medicare's IRMAA, through taxation. So as you start depleting those assets, you're going to see your healthcare costs go up, your Social Security check go down, you're going to see bills mount up, up, and up, and where you're going to take the assets to offset
Those costs and stuff.
that cost, you're going to take it more out of your traditional 401k, which is going to perpetuate the cycle where you're sitting on 400, 500, 600, 100,000 extra in a house that you can assure yourself they can't kick you out of, but your children just don't have to come and mow your lawn every third Sunday.
Is the home equity okay? Under
Home equities
IRMAA?
are great, but a lot of banks are they're not providing them anymore.
What about home equity in the income calculations?
It does not count. Home equity is fantastic. Any loan that is personal, so it has to be a primary residency. It can't be a home equity or it can't be a line of credit off of an investment property. But any loan that you're taking, it's why life insurance becomes so powerful, is the cash value out of life insurance is a loan.
The other thing that I think people don't realize with long-term care, coming back to that for a second, is I have so many people, Dan, that say, well, I got Medicare, I'm covered. And they don't understand that long-term care is not what Medicare is all about.
No, the first thing that people have to realize is Medicare is absolutely one of the best health insurance coverages that you can have.
Absolutely.
And by the way, as a program, a government entity program, it's an amazing group of people that are inside of Medicare. They do a wonderful job. They're doing as much work as they possibly can. There's not enough people inside of Medicare to keep up with the demand. You have to realize, though, Medicare has costs that you have to cover. If you don't cover the costs, Medicare is really expensive. Saying that, even the insurance, the coverage, isn't cheap. It has to be planned for. Now, does Medicare cover certain things? No. Doesn't really cover out-of-pocket prescription drug coverage. Okay. Doesn't cover doctor visits or routine physicals. It can in certain ways, but not in depth. It doesn't cover dental vision, and it doesn't cover long-term care. Does it provide some help? Yes.
Well, short-term windows.
Short-term windows. Can it provide dental and vision? If it's medically necessary, yes. But on the surface, it does not. You have to work inside the program.
Right.
You can get some, as you said, very beginning coverage for long-term care. But if you're in long-term care for more than a few months, you're not having any coverage.
Well, I definitely think, Dan, it really comes back to a much bigger problem in the fact that people don't control so many things that could happen to them in the way of increased taxations, lowering deductions, increasing the brackets, that they should be looking for tax relief. And you've talked about a great tool, life insurance, to do that. And I think, unfortunately, for not trying to be a jerk, but the message is, shame on you if you don't do something about this.
More importantly, not only do people have to start looking at taxation in a bigger picture, in a bigger bubble, and using the right tools to avoid being taxed. What people have to realize when working with any financial professional, have it be an accountant, CPA, have it be a financial advisor, have it be your neighbor that thinks they know a lot about the stock market. It's not about, as you get closer and closer to retirement, it's not about accumulation of wealth. It's about distribution of wealth. It's about maintaining wealth. And that means taxation, that means planning for Medicare, that means planning for Social Security. You can't just blindly do these things because it costs. So what you need to be doing is working with a financial professional that actually understands all the rules and regulations behind Medicare, behind Social Security, behind long-term care, because that's where you're headed. What does everyone think retirement is? Yes, it should be playing golf every day, it should be going to Europe every weekend. I'm not disagreeing. The reality is, it's not. Hopefully it is for at least the first 10 to 15 years, but eventually you're going to get sick, have a slip and fall, bones are gonna get frail. It becomes about healthcare. You need to start planning for it and working with somebody that understands how to maintain that cost. And that's where professionals such as yourself that understand taxation and life insurance work extremely well.
One of the things that drives me nuts is how, in retirement, advisors still tell their clients, stock market, stock market, stock market. Stock market's going to get your income. Stock market's going to help you with long-term care. It's all these things. And people don't appreciate necessarily the amount of risk that they're taking. They just realize that now, and the fact that taxes play a huge role in the longevity of their money.
Regardless of risk, I'll say this harsh, the money that you're putting into a stock market, the money that you're putting into mutual funds, that is just a piggy bank for the federal government to use later on. I am sorry, when you take the money out, you're going to hit a tax. That tax or that income, when you pull it out, is going to be used again, as we've gone through this, to your Social Security benefit to tax it. That taxable Social Security benefit is going to be used to jack up your Medicare premiums, which is a tax, which is then going to take away from your Social Security benefit. You've just created a piggy bank for the federal government to use. Now, if that's your goal, congratulations, thank you, you've done a great job.
A lot of people are doing.
It's what they, but if they so choose to do it, it's not me to step in.
True.
If they want to give as much money to the government in the form of taxation, keep doing what you're doing. If you don't, well, it's time to have a conversation and get yourself out of the hamster wheel or off the hamster wheel.
That's true. And I think one of the things that we do real well is priding ourselves in education and helping people make the best decision possible. So hopefully today with this video, you got a good message and you realize that you do have the ability to take action to help minimize some of these problems, and you should be. So if you want to talk to Dan or I a little bit more, I can be reached at Healthier Money. Our website's healthiermoney.com. Certainly you can give me a shout on the phone, 602-571-1035. But we are so passionate about this. We're trying to help people realize that they need to be taking an active role in trying to minimize their taxes, making their money last, and doing what's necessary to quit throwing thousands and thousands of dollars away needlessly to the government when you don't have to. So, take action.